All right, now we're going to look at preparing the financial statements. What accountants actually their end goal. When you look at an accounting textbook, it's not something, if I was to write a textbook, it's not necessarily how I would do it. I like to do steps in order, from 1, 2, all the way up to the very end. What most textbooks do instead is kind of show you the end result, where we want to be when we're done doing all the intermediary work, the final statements that we want to put out to either ourselves or our clients. And so that's just what this book does as well. To me, it's not maybe the best way, but we're going to work with this. What I wanted to show you is when I mean all those intermediary steps to get us to that final point, or one of the final points, this is what we're going to be looking at and doing today, all the way down here in step 5 of my list. This is a 7-step list that I've came up with that all businesses do on either a day-to-day or all the way out to a year-to-year basis. These first 2 are the day-to-day activities. These are what companies do every single day whenever there's a business transaction. You've got to note it in your T accounts, and you got to do the journal entry. And we're going to talk about both of those in our next class session. And then we come down and we do these next 2, usually at the end of the month, perhaps even as long as the end of the year, depending on how big the business is. We're going to do adjusting or correcting entries, and then we're going to make an adjusted trial balance. So we're going to do these once we get into week 2 of this class. And then once we have this adjusted trial balance, this is like a final, think of the adjusted trial balance is a final balance of all of your accounts. It tells you where you're at the end of usually the month or the end of the year. Once you have all of your accounts, you put them in nice, neat statements. And that's what we're going to do today. We're going to look at those financial statements, that end product that we send off to our customers. So the first statement we do, let's go back to my notes, is we do the income statement. This is also called the profit and loss statement. It's known by a few different names. Primarily, I always call it the income statement, but that's not set in stone. It doesn't have to be called that. What the income statement involves are all of your revenue and expenses. So when we're looking at the T account sheet here, everything down through here, all of the accounts in the revenue and expenses go to the income statement. So that's our first thing that we definitely have to just remember for this class. The income statement is going to tell you how much money have you earned and have you acquired or spent out as well. So the revenues are all of the money that you have earned. You may have not actually gotten the cash. That's okay. You can still earn the money and then be paid later. And then your expenses are all of the money that you have, that people have accrued on you. Things like you may not have even paid it yet. For example, you may have bought something and then you're going to pay for it next month, but it's still something that you have accrued that has benefited you, and so it's counted as an expense, something that you are going to be paying out. And then when you subtract these 2, this tells you how much money you've made through the whole year. When you take in all the money that you've earned minus all of the benefits that you received and that you owe for or paid, whatever's left, that's your net income. That's that bottom line. You can think of it as your paycheck too. Your paycheck is not nearly the same, but think of your paycheck as when you actually make $10 an hour, that's your gross. And then when you have to pay in the taxes, that's like your expenses. And then your net pay is what you actually get to take home, and that's your final amount, the ending product. That's what net income is, how much money you've actually earned throughout the year. Once we do the income statement, we then move into the statement of retained earnings. And the statement of retained earnings is is very simple. It only has just a few accounts. The statement of retained earnings basically connects the income statement and the third one, the balance sheet. These are the two biggies. The income statement and the balance sheet are the big financials. And then you got to have kind of an intermediary in between that connects them. And that's what the statement of retained earnings does. This is also known as the statement of owner's equity because it mainly affects all the owner's equity accounts. And each one is done a little bit differently, but a lot of times the statement of retained earnings only affects these two accounts, the dividends and the retained earnings, and then your final amounts over here. But it can also encompass your capital. It just depends on how the business is set up as a corporation or not. It depends on if you have retained earnings in your business. Because if you're just your own self-employed person, you may not even mess with retained earnings. You may put everything into your capital account, and that's okay. You can do that. But how we're going to mainly do this class is look at it from the corporation side, and we're going to use the common stock and the dividends and then retained earnings as well. I know that sounds like a lot, but we're going to, the statement of retained earnings really only has 4 components. You have your starting amount, how much you have put into the business already. And this, if you're just doing it as a sole proprietor, and I said you could just put everything into capital, you could substitute this out for opening your beginning capital account. And then you add in how much money did you make this year? And then and that came from here, that came from your income statement. And then you subtract out your drawings. How much did you pay yourself or pay in dividends to your owners? And then that equals your ending retained earnings. It's very simple, only 4 things that really go into the statement of retained earnings. And then finally, we get to the balance sheet. The balance sheet is everything else. Anything we haven't used yet goes into the balance sheet. And so that includes your assets and your liabilities. And then it includes the connector. It's either going to be your capital or your retained earnings, depending on how the business is set up. So this, the primary equation, that's what goes into your balance sheet. You have to prepare these in order, otherwise it just doesn't work out. So that's the biggie when we're talking about the financial statements is got to prepare them in order. And then you just got to remember which items go in which statement. And it's just work backwards. The income statement, which comes first, are your very end accounts, the ones on the very right-hand side. And the statement of retained earnings is the combining of the two, and it involves those owner's equity accounts. And then the balance sheet is everything on the left-hand side, assets and liabilities. And then your owner's equity and your ending retained earnings. This guy here, this guy, ending retained earnings flows into your balance sheet. The last item, and I don't have a handout for you on this one, but I can prepare one. The last financial statement is one that we're gonna actually revisit this at the very end of class, but it's called the statement of retained earnings. Sorry. It's called the statement of cash flows. And the statement of cash flows is one of the more difficult statements just because you have to really have a good feel for the accounting equation for the statement of cash flows to work. And when we get to that in our examples, I'll go through this, but I think it's a little, I'm going to go through some of these notes, but I think it's a little premature to do that right now. So before we do that, what I want to do is simply practice preparing the income statement, the statement of retained earnings, so you can kind of just get a feel. So I want you to pull up that document from our module. Go in here into the 14.5 Davis Park. And we're going to prepare the three financial statements, the three main ones. All right, I'm going to pull up our that 14.5 example. So remember the one thing I said you needed back in our notes. I'm going to pull that up here so you can see it. The thing that you needed to prepare the financial statements was this adjusted trial balance. And it's a list of all of the account balances of where we're at right now. So this is what an adjusted trial balance looks like. Move this out of the way. Here are all of my asset accounts that the company has. Not very many. You can see I have two counties that owe me money, the Madison County and Johnson County. I have some prepaid insurance. I have something long-term, land. I own some land. And then you come down here into the 200 accounts. These are our liabilities, things that people, or things that I owe. A lot of times it's money. But in this case, it's also with the unearned revenue. It's I owe a service to somebody. Then we keep coming down. We got our owner's equity accounts, things that the owner has put in 50,000 of their own stuff, whatever it's cash or equipment. They've paid themselves 20,000. And then they have retained earnings, what they've accumulated in earnings throughout all the years that they've been in business. They've accumulated 36,000. And then this year, what's happened this year in the business? They've earned 310,000. And then they've had an benefit provided to them of all of these amounts. So they've had insurance, some miscellaneous stuff. They've used some supplies in their business like printer paper, printer ink, whatever it might be. They've had to pay the utility bill. They got the use of utilities. And then the biggie, which is usually the biggie for most companies, is the labor. They got the benefit of labor. We're going to use all of these accounts to prepare the financial statements. All right, so let's do them in order. Remember, the first one we have to do is the income statement. So if I were you, I would use this and maybe just, you can either do it off to the side or you can pull up a new sheet. And let's prepare the income statement. All right, so with the income statement, one of the first things you always do when you're preparing a financial statement is you have a proper title. And so here's my title, and all statements look like this. They have the company name up at the top, who it is that you're doing the financial statement for. Because if you're like a CPA office, you may have 50 different clients. And so if you just had the income statement, but you didn't know who it was, well, that's the reason we have this here. And then the second line is always telling what it is that you're working on. And then the final line is the date of that income statement, because are you looking at last year's? Are you looking at 3 years ago? Well, this is going to tell us that. And the as of, you're going to see that that's on the first two financial statements. The as of is basically means for this year only. So we're only looking at the revenues of this current year. We're not combining revenues for the last 3 years. When we get to the balance sheet though, the as of drops off because the balance sheet is a summation of the business where it's at right now, all of the years combined. All right, so we're ready to do the income statement. Remember, the income statement does everything at the end of the equation. So we start off and we have over here along this side, these are our accounts. And then we have over here anything with a debit balance. And again, I know we haven't talked about debit and credits, but we will next time. Anything with a credit balance. And you can tell if it has a debit or credit balance simply by the adjusted trial balance. Now, I need to clarify this, and I wish I wouldn't have said that now. I was going too far. Nix that, what I just said, let's call this the subtotal. We're gonna call this the total. Because once we get to the financials and this is where we deal with debits and credits. The financial statements, we actually, we no longer deal with debits and credits. We deal with subtotal and totals. Well, with the revenue, I only have one revenue account. So there's no reason for me to subtotal it. I can just put it out there as my totals. I had $310,000 that I have actually earned in the business this year. And then we go through and begin to list all of the expenses. And doing the financial statements isn't really hard. All of the work is done for you. The financial statements just put it in a nice, neat order and give you final amounts that an investor or anybody looking at the company can kind of give a good snapshot of where the business is and how much money they've made this year. So the next thing we're going to do is we're going to subtotal all of our expenses. And for now, I want you to get used to writing out the expenses. As you get a bigger company, you may have 100 different expenses. And so you begin to summarize them into different summary categories. But for now, we only have 5, so it's not that bad. So we're going to have kind of a new category. We're going to put all of our expenses underneath. And then we're going to subtotal them. So I'm going to give you, let's give you a minute here to jot these down or to type them out in your Excel document or on your piece of paper. Because I think having this, when we get to do the homework examples, that'll make the homework a lot easier. You'll be like, oh yeah, I know, we did that. Okay, again, it's hard for me to see how far along you are, and I don't want to have a lot of dead time. So we want to add up all of these expenses as our subtotals, and then put the final amount out here in the total expenses. And you always better hope that your expenses are less than your revenue, otherwise your business isn't doing very well, obviously. So the business brought in $310,000. We paid out $240,000. Essentially, we paid it out, or we will pay it soon. So remember, the whole point of doing the income statement is to figure out what our net income is. How much did I actually earn this year? And I earned $70,000. The money that I earned minus what I paid out in expenses. Now, if I was doing this as well, I would go through, and until you get familiar with it, with the statements, you may want to put an X next to each one of these. Because everything on this adjusted trial balance gets used once and only once. So now that we've done the revenue and the expenses, those aren't going to show up on any other accounts, on any other statements of the top 3. We will get those again when we do the statement of cash flows. But the three main financial statements, we've now done the income statement, and it includes all of these guys. They're done. Now we're ready for that middle item, that statement of retained earnings. So we make another proper title. Company name. And what it is we're working on. And the date. And then, like the instructions, how we had in my notes, we're only going to have 4 main things here in this very small financial statement. It's a connector. Okay. And we're going to have a subtotal account again, or column, and a total column. And as my notes say, we start off with our beginning retained earnings. Okay, so our beginning retained earnings, we're going to use it so it gets an X. 36,000. Put that over here into our total category. And then we bring in the connecting piece that connects our first to our third statement. We bring in our net income from up here. And our net income was 70,000. So we add that in. And then we subtract out our drawings. Drawings and dividends, remember those are the same terminology, so you can use one or the other and it's fine. So I put that as a negative here. Technically, you probably wouldn't. I just put it in there to remind any users that that is for sure a subtraction. Oops. Obviously, you would get that from the over here where it says less dividends, but I put that there just to remind us that definitely we need to subtract. And then when we subtract, we get our total here from our subtotal. That's all I did here is just combine these two. So I come up here, the dividends were 20,000 and put an X on the 20. And then finally, it's just add up our beginning plus our change. This was our changed amounts. What changed for the year? Money we brought in minus money we paid ourselves. Our new retained earnings is 86,000. And so what you may want to do is out to the side. This is a brand new number that we haven't used yet. So remember that that's gonna be in our final balance sheet. We've used the 36 to get to the 86, but we haven't actually, this is just a summary, kind of like our net income was a summary. Now, anything that doesn't have an X, so this 86, the 50 for capital and everything else is going to go into our final financial statement. So let's go now to our final financial statement. First thing, proper title. And then on this one, we also have subtotal and total. When we're doing a balance sheet, After you have your proper title listed, notice this one doesn't have as of, because the balance sheet is a snapshot of where the company is at that particular moment. So this doesn't mean that I had just $64,000 cash just this year. No, that's what I have in my checking account right now, all the years combined. So I'm going to list first, and you can see here I have it set up. I don't remember if all the homework has it cut out between current and non-current, but we're going to do it like that just in case. The assets are first divided among current and non-current. And that's one of the reasons we have these numbers out here to help remind us. Basically, anything that's going to change within the first year, within a year, are considered current. And then anything down here is our non-current items that we don't expect to change, like buildings, land. There are some equipment. A lot of equipment are going to be long-term items. So we're going to put these first. Now, on a balance sheet, that's something that other people outside of our business can see. This trial balance, this is for this company's eyes only. They're the only ones that look at this. So we can put these ARs separate. And in our T accounts, we can put the ARs separate. But for the balance sheet, when we actually, if somebody requests that, like a creditor, a bank, they want to see what our business is worth. It's not really any of their business who owes us money, just that somebody owes us money. So when I'm preparing my balance sheet, I'm going to combine all of my ARs into just one AR. I'm going to condense everything and to make it as user-friendly, reader-friendly, and just to protect myself or my clients. It's not necessarily to know who owes me, just that somebody does. So I'm going to have an account receivable of all of them added up. And then if I had more prepaid expenses than just the one, I'm going to combine all of those as well. And then we're going to add up, and we're going to put X's out here now. We've done our cash. We've added up the two account receivables. And we've done the prepaid insurance. I'm going to have to plug it in. May have to do a quick. I'm going to pause this just for a second while I go get a charger. Just give me about. Okay, so we've got, pull up our balance sheet. You should have, we can now put the current assets in, which we only have one. And then we total it. So I've put in all of my current, and then as you're putting them in, I would get in the habit for at least a while to put an X out here to remind you that you've done it. You don't need to do it anymore. I only had one non-current, so that's easy enough. And then simply add up our current and non-current, and that's our total assets. 203. And then if I go back to my T accounts, we're going to see how we're going to kind of go full circle from where we started the first thing today. This number, instead of being 10, well, it's a much bigger number. 203,000 for all of our assets. Now, we hope that these two amounts over here, when added together, will also be 203,000. All right, so let's start now with our liabilities. Just like the assets, and you don't have to, you can do these straight down. I just have them vertically for printing for when I want to print it out. But you don't need to do it sideways. You can, it doesn't matter. You can just keep going straight down if that helps. So we have our current liabilities. These are items that I expect to pay in the near future. So I don't expect them to be outstanding for very long. So when I go back to my trial balance, any account payables that I have, I'm going to combine all of those into just one account payable. I only have one, so nothing to do there. But just like the ARs, when I combine them, I'm going to do the same here. I'm just going to have one AP account. And then I'm going to have my wages payable. I definitely expect to pay my workers within the next year. Otherwise, they're going to be very upset. My unearned revenue, people don't usually pay for benefits more than a year ahead of time. I'm probably going to provide that service within a year. So I'm going to go ahead and put that one in there as well in my current liabilities. However, this big note payable to the bank, that's a large amount. I'm probably not going to be able to pay that off in just a year. So therefore, I'm going to put that as a long-term liability. So let's go ahead and now update my liability section on my balance sheet. Got all of my account payables put in. I'm sorry, I don't have my screen shared. Let me get that up. There, that's better. All right, now you should be able to see everything. Again, I was just going through and putting X's here and now putting into my liabilities. Having a subtotal and a total column again. And then putting in my non-current, my note payable. And then just adding the two up. So I have total liabilities of 67,000. So I'm going to put 67,000 over here to see if my equation will balance. I have 203 over here. 67 plus something better be 203. That's what we're shooting for. All right, we're ready for our last little section. So now we've got X's on everything except this guy and our new retained earnings amount. That's our connector piece. Remember, this was our total. It's our connecting piece that goes into the balance sheet statement. All right, these are the only two guys left. Let's put them into our balance sheet. We first have capital. So we have our owner's equity. Capital is at 50,000. And then my connector, the 86,000. Remember, we got that from the other statement, and I put that here as a reminder. So now that I've done these, I can X them out. Everything now has an X in my trial balance. I've used all of the accounts once and only once. Total up my owner's equity. And you get 136,000. So I put in 136,000 over here. And then what the balance sheet does is simply combines these two and says, okay, do my total liabilities and owner's equity, what do they equal? And they better equal the same thing as what my assets were. And they do. My assets were 203. And then when you add these two up, it's also 203. That is your check figure to see if you've done everything right. full circle. Did the accounting equation actually balance? Okay, let's, now that we've done the financial statements, let's take another, let's go about 8 to 10 minutes here. Let's come back at the top of the hour. And we're gonna go in and hopefully, if while you're, maybe, let's go 5 after, let's give you time for a break. But then I want you to go in and go into the McGraw-Hill, the practice, or at least sign up for the McGraw-Hill if you don't already have that. You can go in, and if you don't have your code yet, you can do the free temporary code. It's like a 14-day code. I would go in and do that during this break time. So we'll be back at 5 after, give you time to do that. And we're gonna go into the, let's go into our class. And we're gonna, in the modules, once you have signed in with McGraw-Hill and got your temporary access, or if you have your code, great. We're gonna go down to the bottom of module 1 where it says optional practice. And that's where we're gonna start up our last section for today. So about 5 after, we're gonna do that. I'll see you back in 10, 12 minutes.